Testing, testing. I'm here. I'm back. Patterns and Profits podcast. This is for week ending July 12th, 2024. I'm actually recording this on a Thursday afternoon, July 11th. Haven't been here for a few weeks. What is going on? What have you people been doing? So I took some time off. I had a great 59th birthday. Man, I the older I get, the more I'm hearing my father saying, "You guys had it so much better than we did as kids." and I hear myself saying that too to my kids. You guys have it so much better than we did. And I believe that. Probably just like my father believed me too. What has been going on in the last couple of weeks? I am glad to be back. Kind of jaw-jacking here on my podcast. Wow. I mean, what has not happened in the last few weeks? I don't want to go political, and I won't for very long, but that debate debacle, I mean, call it what you will. I mean, it just like I saw it. It was actually on my birthday, and I saw it that night, and it looked like, I just, I felt bad. I felt bad for the guy, for the president of the United States, the leader of the free world, staring like he was staring at that blank stare you have in space. But and then there's Trump on the other side challenging him to 18 holes of golf. This is what we're left with, guys. Wow. Hey, listen, I'm not one for politics when it comes to, obviously, Patterns and Profits podcast. I will say this. I believe if you want something in this life, you got to go out and take it. You got to take some risks. You got to go out and get it. No president directly affected my back pocket, and I believe that's probably the case for you. I will say this. So I've been looking at the last 5 to 6 election cycles, election years. Okay, you got to go out 25 years to get the last 6 election cycles to see if there are any stocks that go up the 30 days before election day and or the 30 days after election day. And guess what? I found some. I'm not ready to release those yet because I still have some more work that I want to do on these stocks, but I will be releasing this information not in the not too distant future. So, all right. So let's talk about what's happening this week. So, take a look at what's going on in the stock market. Take a look at what's going on in the bond market. Take a look at what's going on in currencies and commodities and, the most recent news we've had come out. The S&P has just been in melt-up form. And all of a sudden, here we are Thursday. We get a little CPI data that comes out, and it's weak. And all of a sudden, we open higher on Thursday with the idea that rate cut's coming. And then all of a sudden, traders get one of those aha moments, something that pattern traders have known for a long time. Rate cuts come because the economy gets soft. What happens to the stock market when the economy gets soft? It starts to fall. Okay? It starts to fall. And so, you look at the S&P 500 as we get into the especially Thursday. I can't tell you what's going to happen on Friday. I don't know what's going to happen in the future. All I can look at is past and present to try to get a prediction for the future. But is this the beginning of the potential turnaround? Because yes, lower interest rates are great for the stock market, but the stock market's been going up on high rates for quite some time. I mean, take a look at what's happened here for 2024. What do we got? 17% up in the last year, I think is what we're seeing. It's like 4 or 5% that's gone up just in the last 30 days. So this has to come to fruition. And, you get, for instance, last week's jobs report. We powered higher through that. We've been powering higher through everything. And all of a sudden we get this consumer price stuff that's telling us that the consumer is finally starting to feel it. Or at least they've been feeling it and really kind of kicking that can down the road. And I don't know if they're going to be kicking it down the road for too much longer. So, you look at the stock market, we're starting to see that. The bond market has been reflective of potentially higher rates to stick around, but it's starting to affect people's back pockets. Here's an example. Look at the airline industry. All right. So Delta reported earnings. They just came out with earnings. Their earnings were okay, but it's what's happening is what they're seeing going forward is they're seeing prices coming down. So flights, not just for Delta, but other companies, all right, United, JetBlue, the whole works, they're all starting to drop their prices, and they should. And they should because airline tickets have been crazy. But I'll tell you what, Delta reported those earnings, and they were down nearly 10%. They were down 10% before the market opened on Thursday. Now, they brought some of that back, but here's the thing, all right? When you go out and you start looking, here's the things that we're seeing, all right? Household traveling since 2019 to get to travel costs up 30%. Okay. Delta Airlines has found that there is a price that people will not pay to fly. And they found that out with the earnings that came out because their earnings disappointed. So that's a problem. The other thing that I noticed, and I noticed this early, is that I've been doing some trips back and forth to New York. I got a few more that are planned for the rest of this summer. Now, my family is a little different than, we're not planners. I'm a planner, but every time I plan, I have to replan because things change. So I've been now trained to just wait until that last possible moment and then take that flight. It's going to hit me in the back pocket really high. Here's the funny thing, though. It hasn't been as bad as I thought it was going to be. And I'll tell you why. All right. So a couple things I've learned for air travel just in the last couple of years coming out of COVID. We're spur of the moment, folks. So we change things a lot. You know what else I've kind of learned? At least domestically, first class isn't really first class anymore. As long as you're not going coast to coast, if you're going coast to coast, first class, you might be able to get on one of those extended range seats or the flat beds, but going up and down the same time zone, it's just not happening. I'm just not finding it. So the only thing first class offers to me is maybe a seat that's made for the size of a human. If you want real first class, you got to fly overseas. That's where you actually get true first class. But also, we're seeing more and more seats getting stuffed into the same size airplane. Take a look at Allegiant, for instance. I mean, wow. That A19 that they have, the tray table is about the size of an iPhone Max. That's how small the tray table is. You can't put anything on it. They also do not have reclining seats on this flight. They've already pre-reclined them for you, so nobody gets hit in the head from the guy in front of them. Now, I kind of like that, but boy, when you slide into a seat on Allegiant's A19, you better grease up before you do because there's not a lot of room between your seat and the guy in front of you. That's something I've kind of learned. JetBlue, for instance, most of the JetBlue flights do not have first class. They have that premium economy. All right. But here's where I'm going with this. I used to, when you book flights, if you waited until 2 weeks, prices were very high and your seat selection was very low. All right. That hasn't happened to me this summer. I have waited until days before the flight and went to JetBlue, and I've clicked on, I think it's Blue Extra. They have like Blue Basic, Blue, and Blue Extra. I believe that's how they have it set up. And so I went with that blue extra because you get a bag, you get a carry-on, you get a couple things. Anyway, here's where I'm going with this. I wait, week or two out, and typically there's a lot of seats still left on the flight. I'm going to check it right now. Okay, so let's say I decide to go from Tampa to New York or Sarasota to New York on JetBlue. And I'm clicking on JetBlue's website right now. And let's push this out to a couple weeks. So I'll look at 1 week, but let's look at 2 first. 2 weeks show. Here's the thing. The back of the plane, most of the plane looks like it's already full going to New York. The front of the plane is almost wide open. I mean, it's all the plane that has all the parts of the plane that have the even more space wide open. What is that telling me? It's telling me that people are not paying up for this extra space. You know what they're doing? They're rolling the dice and they're holding out, and they're doing the blue basic, which means they're not picking their seat. JetBlue's going to pick it for them, and maybe they might get lucky, and they might get pushed up into an even more space seat because they're not selling like they used to. That's what I'm talking about, folks. Okay? I'm looking at it right here. I'm looking at it right now. The cheap seats are taken. The expensive seats are not. My point is that people that are booking early are just taking the basics. All right? So you've got the folks that book early, they're taking. I'm amazed the amount of middle seats in the back that are taken because they're the cheapest seat on the plane. All right? So that's what's happening. Prices on these tickets have been dropping, but they're still expensive when you add up all the fees. I mean, when you add on carry-ons, I mean, they literally charge you for carry-ons now. I know some of you are like, Tom, where you been? This has been happening for a while. I didn't know this. I mean, I kind of knew it, but I figured you can get on with a carry-on. Nobody will notice. No, they tag your carry-on. They tag your carry-on that goes in this above you, and then they see you coming on. And if you don't have that tag, you don't have that little band around your carry-on, it's going under the seat, or you're going back off the plane, or they're going to charge you. So that's something. The big question I have is, are airline stocks telling us right now that the market is finally getting soft? All right. And I'm talking about more than just airlines. I'm talking about vacations, all right, resorts, hotels, cruise lines, subscriptions like Netflix, packages from Amazon, iPhones, things that people want, but they don't necessarily need. All right. So that's kind of my startup on here. But here's the thing, folks. All right. This is overall market stuff. We'll see where the overall market ends up landing. But as a pattern trader, my question is, can I find patterns that happen in earnings? Yeah, because I have the data. I'm a data nerd, okay? If you know anything about me, then know that I'm a data nerd. I look at data. I sift data. I sift data like someone might sift flour when they're mixing it with other ingredients. I do that with the markets. I'm looking at 6 stocks right now. Is it 6? Yeah, 6 stocks that have interesting patterns that happen around earnings. So what I do when we come into earnings is, you could look at earnings and you break it down into 2 areas. You've got your report, right? You got your earnings report. It could be any stock. You got your earnings report. You've got what happens before the report, and you got what happens after the report. Now, I want you to think about this with me for a minute. Is the markets are they more or less volatile before the earnings report? And is the stock more or less volatile after an earnings report comes out? All right. If you've looked at any stock prior to earnings and then looked at it again right after earnings, I think you know the answer to that question. And the answer is that stocks tend to be less volatile before the earnings report comes out and more volatile after the earnings report comes out. So as an investor, as a long-term investor, you probably don't care about that stuff. You'll go through before and after because you're thinking years. You're thinking years and not days or months as a trader. But as a trader, you got to think to yourself, where's the risk? Where's the risk on the trade? The risk is holding after an earnings report, because after an earnings report, a stock could pop, a stock could drop, and it could go against you. Okay? So if I'm going to trade earnings, I would love to find stocks that typically go up before a report comes out, on this anticipation that they're going to beat, they're going to beat, they're going to beat. Or if I could find a stock that patterns down before a report because everybody thinks they're going to miss again, they're going to miss again, they're going to miss again. And so those folks are patterns, right? Those are patterns that you could trade stocks on. Those are patterns that you could trade options on too. Okay, let's talk about stocks for a moment. So I'm going to share one of these stocks with you right now here on the podcast. All right. So if you're listening to me and you want to check this out for yourself, go check out PPG Industries. PPG. All right. What does PPG do? PPG is paints, varnishes, lacquers. All right. We know what they do. I want you to first look at the stock. So I want you to look at the stock for this year. Because if you look at the stock for this year, you know where its high was? At the beginning of this year. The highs for this stock were near $150 a share. Where's the stock at today? 128. Did it get to 128 shortly after the beginning of the year? Or did it just dribble its way down there during the entire year? It dribbled its way down. It created a pattern of lower highs and lower lows. I know you can't see this. I'm putting the visual in your head. It basically looks like you're walking downstairs. And that's what it's been doing. It's been stair-stepping down all year long. Now, it's interesting because PPG has been dropping long before the market. If you're at $150 on January 1st and your low was 125, and it just pepped up this week a little bit, then you've suffered a 25-point decline throughout the year. That's about, I want to say about 17, 18% off for the year to date. Okay, there's the visual. Here's the part that even if you were looking at it, you might not know. All right. Did you know that PPG Industries, for at least the last 4 quarters, has dropped in value? All right. The 2 weeks before earnings. The 2 weeks before earnings, this stock, in fact, was you look at 1 week before earnings, the price, 1 week before earnings, the price of PPG was lower than it was the day of earnings. So that week prior to earnings, this stock dropped. It dropped in 2023, right? It dropped in Q2. It dropped in Q3. It dropped in Q4. It dropped in Q1. So it has just that 1 week. That 1 week, the stock has dropped and dropped and dropped and dropped. So looking at it, no guarantee it's going to do it again, but it's got an earnings date on the 18th of July. We'll see what happens to this thing. I mean, yeah, it's down a lot, but you know what? It's been trending down. It's possible that it's going to trend down even some more. Love to see what this is next week and see how it turns out. All right. So there's a pattern. What do I do with a pattern? All right. So first I spot that historical high probability pattern. So you got one in earnings with PPG. Next thing, I create an appropriate trade. So appropriate trade would be I could short the stock. Okay. Yeah, I could short the stock. The other thing I could do is I could go in and not only short the stock. You would short it, let's say, a week prior, but you want to buy it back before that earnings report comes out, because once that earnings report comes out, that the pattern doesn't go beyond earnings. The safe pattern is before earnings. The unsafe pattern is holding it through earnings. So we can short the stock. What else could we do? We could take a bearish option trade. Now, how many different option trades are there out there? There's tons of different option trades out there. But let's just take the simplest, buying a put option. So what are put options trading for? What is the at the money put trading for right now on PPG? It's less than $250. Okay, less than $250. What happens to most stocks as they get closer and closer to earnings? What happens to their option prices? Well, directionally, we don't know. But as we get closer and closer to earnings and more, I call it advertising. That's what it's talked about a lot on financial channels. When that happens, option premiums tend to go higher, okay? The time value, the extrinsic value, which makes volatility on these options go higher. So there's that volatility that actually goes in your favor for a short term. I know any of you that have learned anything about options, you know that options, they decay in value, and they do. Time decay is real. It happens. But there are certain times during the year on certain stocks where time decay can stand still because volatility is taken over and angst is taken over, and people are nervous about what's going to happen during that earnings report. So they're buying insurance and they're prepping up put options in case they own the stock. They're prepping up call options because maybe they think there's going to be a beat finally. I don't know. But what I know about PPG is this. It's been in a downtrend all year. Last earnings was a miss. Okay. But even when they beat earnings the prior quarter, the pattern was down until the earnings report came out. Earnings are next week on PPG, and the smart money is buying puts on these until then. Smart money knowing what happens to PPG the week prior to the report. And again, I'm going to say it one more time. I can't guarantee this is going to happen, again this week. But that pattern is what I'm interested in. Patterns. What patterns do? They take a lot of the emotion out of trading. They allow you to trade. I call it trading like a computer. A computer doesn't have emotions. So if you can get into that area and trade with less emotions, you're more than likely going to have a more consistent outcome. So a couple things I find that work. Number one, trade something where you can spot the results in the past so you feel better about what the future might hold. Number two, look at alternatives other than buying the stock if it's bullish or selling the stock if it's bearish. And number three, and this is what I want to talk about for the last part of our podcast today, is risk management. Now, I know risk management is one of the most boring subjects, but if you've been around the block for a while as a trader, you're going to find that this boring subject is probably the most important out of everything when it comes to trading. So biggest question I get when it comes to this, and I just got it last week, all right, is how much money do I put into a trade based on my starting capital? All right. Let me just say this. I'm not your money manager. So what I'm about to say when it comes to trade risk versus portfolio management is strictly for educational purposes. I want you to go out and you to do the homework and you find what fits best for you. But trade risk and portfolio management, two entirely different things. All right. Trade risk is the ability to control the trade, the one trade you're thinking about right now, or a trade by trade scenario, where portfolio management is the ability to control several trades over the entire portfolio. Okay. I'm looking at my Robinhood account right now, and it's Thursday afternoon. I'm seeing the market dropping. I'm actually up a little on the day on my Robinhood account. And I'm looking at it, and I took an 18% hit today on one of my trades. Okay. But I've got, no, I'm sorry. Yeah, I got an 18% hit on one, but 9% positive number two. I got a trade that's up 2.5% today. I got a trade that's up 1.75% today. I've got a trade that's up 1% today. I got a trade that's up 2.69% today. And I got a trade that's up 7.14% today. And then I got a couple stocks in the portfolio too. So where am I going with all this? Where I'm going with this is that when you focus on one trade, you're focused on risk management. When you have a series of trades, even when one of them is down almost 19% today, these are option trades, by the way, just in case you're wondering. I got all these other ones that are more than making up, and my overall number today is slightly higher. Okay, but let's continue on. So let me look at my Schwab account. All right, my Schwab account's down today. But it's not down as much as it should be because I've got some things going on in my Schwab account that are actually helping with the things that are getting hurt on, like Intel's one of my long-term positions. And I'm down quite a bit today on Intel. But you know what I'm up a lot on today? Gold, GLD. GLD is helping the cause. Portfolio management. Let's dive into this a little bit deeper here. So, I talk about money management, and I talk about portfolio management, and let's start with the very, very basics. Let's say you have a $5,000 account, okay, and you decide I'm going to make my risk per trade $500. Now, in order for your $5,000 account to go to zero, what do you got to screw up? You got to lose 10 times in a row, right? $500 times 10, and you got to lose the entire amount 10 times in a row, which means that you got to really be a bad trader to take a $5,000 account to zero. Now, let me tell you how you can do that. So, I'm going to tell you how you can be a really bad loser. All right. If you take right off the bat, we're going to talk about this a little bit more. But if you take your your $5,000 account, you divide it all up into 10 trades, and you put you go bullish on all 10 of these on the same day on stocks that are all moving in the same direction. That's how you can take a $5,000 account to zero. All right. That's 10% per trade on the account, something we call risk of ruin. All right. So your risk of ruin can be many things, but I want you to think of risk of ruin just to start off as, trade risk. You take account divided by trade risk. So, you're talking about 10% per trade. So how do you lower your risk of ruin without one of the easiest ways to lower your risk of ruin that does not involve your trading itself? Well, cutting your max risk per trade. So if you go from $500 max risk per trade to $250, you just cut your risk of ruin in half. All right. And I'm talking about your trade management side of this. So you're going from 10% risk per trade to 5%, which means now you got to be wrong 20 times in a row and take a maximum loss of $250 on each of those trades. That's something that's kind of hard to do. Now, for those of you that want to follow me a little deeper in the rabbit hole, and let's just take a few minutes and talk about other ways we can lower our risk of ruin. And what we can do is we can take a page or two out of the investor's playbook with a word that I like to call diversification. Now, diversifying isn't just for long-term investors. As a trader, we can diversify as well. So I'm going to give you some ways of diversifying as a trader, as a 30-day trader, okay? Not as a multi-year investor. Now, multi-year investors diversify by security, right? We can too. All right, we can do that too as traders, even as option traders, because not all stocks go up together. So, what you do is you take a look at your stocks or your trades. You take a look at your trades in question, and before you put them on, you go back and you look and see, well, what do the overall market, when the overall market goes up, what do each of these underlying assets do? Do they all go up with the market? That's called positive correlation. Do some of them go against the market and go down when the market goes up and goes up when the market goes down? That's called negative correlation. Are there some stocks that go against, that just go their own way? That's called random correlation. So you need to know how correlated your stocks or your trades are when you compare them to each other as well as the overall market. All right. You know, I was looking at the Magnificent Seven, and I ran correlation on Magnificent Seven, and a lot of them correlate well together. There's a lot of positive correlation there. Tesla, you know, sometimes it's on the Mag 7, sometimes it's off the Mag 7. It depends on what analyst you're watching on mainstream television that day. But let's call it part of the Mag 7 because that's what it is. Tesla is negatively correlated because it's been doing a lot of the opposite of the other 6. So that's called diversification by security or by asset. Let's talk about diversification by time. This is another one that we can take from the investor, from the long-term investor, and apply it to trading. Because time is a wonderful thing, all right? When I trade a specific strategy, I don't put my entire account in at one time, no matter how many stocks or opportunities that I find that I can trade options on. You know, we really don't know when the big panic button's going to get hit, and we really don't know when the big melt up is going to hit, okay? Either that huge breakout to the upside or that huge breakout to the downside. What you want to do is you want to take your account, you want to spread out your opportunities over time. That hedges time risk. Now let's continue. Now what we're going to do is we're going to talk about 3 different diversifications that traders can do, but investors can't. All right. Number 1, diversification by direction. Let me tell you something most, if not all, investors do is they all go long something. They might go long stocks, and they can diversify by different stocks. And they can diversify by adding some commodities in there or some ETCs, exchange traded commodities. But they typically, your average investor, long-term investor, doesn't short things. Okay. Now, what happens in bear markets? Well, as traders, we can short stocks. As traders, we can buy puts. As traders, we can do put spreads. We can do bearish trades to hedge bear market risk. Okay. This is where trading like a hedge fund manager makes a lot of sense because you don't have to just short stocks in order to hedge direction. There are dozens of different option strategies that you can take. All right. Those are some things that we can do by hedging direction. How about diversification by the system that you're trading? Is your system a trending system? Well, there are some trends down, like PPG, okay? And so you could take diversification and apply it to systems. It'll curb your directional risk because what it does is it will further focus you on emotion. Because if you've got a system like, okay, let me throw it out there. All right. One of my favorite trading strategies is something I call the money calendar. It's a seasonal trading strategy. You know, I get bearish seasonal opportunities as much as I get bullish seasonal opportunities. Sometimes more, sometimes less, depending on what the overall market's doing. But, you know, for July, the first 2 weeks of July, I have nothing but up. Well, we're almost done with the first 2 weeks of July. Guess what happens in the last 2 weeks of July? We start to see just as many bears in opportunity as bulls. And by the time we get to the last week of July, it's mostly bears. Now, for all of you why guys out there, you know, those are the folks that say, why is this happening? All right. I always like to have a quick answer, and that is because there's more sellers than buyers. But one of the things that I believe happens at the end of every July is we get deep into Q2 earnings. And typically Q2 earnings are a bit softer. And that's why we see this uncertainty that happens coming into the end of July and going into the beginning of August. So diversification by system makes a lot of sense. And it also could represent different time frames too. Next, diversification by strategy. This is where we go into alternatives like option strategies. Because option strategies, first and foremost, there are bullish strategies, there are bear strategies, there are neutral strategies. But is that it? No. There's option strategies that work regardless of what the way the market goes. There are option strategies that work when the market goes nowhere. Depends on volatility, right? Some option strategies have high rewards with limited risk. Other option strategies have larger risk and limited reward. You might wonder, why in the world would you want to do that? Because it comes with high probability. That's why. All right. But here's the thing. If you understand diversification by strategy, then you're better equipped to know when to be on the long side of options, meaning buying options, and when to be on the sell side of options, and that's selling option strategies. And I'm not talking about selling with open-ended risk. We could do spreads. You want to learn all the option strategies and start to utilize some of them as part of what I like to call strategy diversification. All right. So I said a mouthful here in the last 10 minutes, but basically, I want you to think of this as a summary. What is trade risk management? It's simply the amount of money you're willing to put on any one trade. What is portfolio management? It's much deeper, okay? It's focusing on the entire account, not just one trade. It means having more than one system, all right? You don't want to have the one system that you trade is nothing but going long stocks and buying call options on those stocks, because eventually that's going to hurt you. So you need to have more than one system. I want those of you listening to this podcast, I want you to think of being be a jack of all trading strategies. Be a master of two or three. Okay? That means having more than one system, having more than one strategy, having more than one trade, and having more than one timeline in place at once. You'll get there. I know some of you I'm talking to right now are saying, "Oh, this is impossible. This is too hard." All right? It just takes time, folks. And portfolio management also means reevaluating your plans every so often, because the market changes gear. I mean, think about it, folks. It's 2024. When's the last time we saw anything going down in any great substantial amount? Was 2020. All right. We had a big pullback. Didn't last long, but we had a monster pullback during COVID. Before that, you got to go back to 2008, 2009. So we had literally 10 to 12 years of move higher from 2008 to 2020. We had a quick pullback. We're moving higher again. Where do I see this market going long term? Higher, but the volatility is coming. Okay? It's not going to be as easy for that buy and hold person. It's going to become, in my mind, a trader's market. So understand portfolio management, understand the different types of diversification that we want to do as traders. All right. Hey, listen, if you made it this far in the podcast, congratulations. I probably should do a video or two on this subject, because it's tough to digest all this in one sitting, especially in the short amount of time that we have here. So anyway, hey, thanks for joining me. Have a great weekend. Take a deep breath. And I'm going to slice and dice some of this up into future videos. All right. I'm out. See you guys.